Welcome to this presentation on IFRS 5. IFRS 5 deals with non-current assets held for sale and discontinued operations. Now, before we get started in this presentation, let's just have a look at the objective of IFRS 5. So the objective of IFRS 5 is to specify the accounting treatment for assets that are held for sale, okay, and the presentation and disclosure of discontinued operations. So that really is what the standard is about. Now, IFRS 5 requires that assets that are held for sale should be measured at the lower of their carrying amount and fair value less cost to sell. And any depreciation on these assets should cease. And really, this makes a lot of sense because if you're intending to recover your asset through sale, then it means you no longer recover it through usage. And depreciation is the expense that we recognize for reflecting the fact that we are using the benefits embodied in our asset. Okay, now non-current assets that are held for sale are going to be presented separately in the statement of financial position. And the results of discontinued operations are also going to be presented separately in the statement of comprehensive income. Now, what about the scope of IFRS 5? It's important to understand the scope. The reason why we need to do this is so that we can understand which assets fall into the measurement provisions of IFRS 5. Okay, because if these assets do not fall within the measurement of IFRS 5, measurement provisions, of IFRS 5, then we need to look at other standards in order to understand how we account for these assets. So the measurement provisions of IFRS 5s are not going to apply to deferred tax assets. Those are covered in terms of IAS 12 income taxes. Also, assets arising from employee benefits are going to be covered in terms of IFRS 19. Any assets that are covered in the scope of IFRS 9 are not covered in the scope of IFRS 5. Any investment property that is being recorded using the fair value model in terms of IFRS 40 is not within the confine or within the scope of IFRS 5. And also, if we have any non-current assets that are being measured at fair value less cost to sell in terms of IFRS 41 agriculture, those assets would not find themselves in the scope of IFRS 5. Now let's talk about initial recognition. So when we want to classify our non-current assets or disposal groups as held for sale, okay, the first thing to understand is that paragraph 6 tells us that we can only do this if we expect that the carrying amounts are principally recovered through sale rather than through use. So this is quite important. And of course, we're going to stop depreciating these assets. Now, we can only classify these non-current assets as held for sale if we satisfy two criteria. So the first is that it must be available for immediate sale in its present condition, subject only to terms that are usual and customary for such sales. Okay, so it must be available for immediate sale. And the second criteria is that the sale must be highly probable. Now, paragraph 8 gives us guidance as to what it means for a sale to be highly probable, but we're going to get there. Just wait a little longer. Okay, so before we get there, let's look at examples in IFRS 5, in the illustrative examples, to really look at whether we satisfy the criteria of it being available for immediate sale and the sale being highly probable. So we're going to look at 3 examples, and the first one is example 3. Okay, so in example 1, we're looking at 3 examples, and the first one is example 1. Okay, so in example 1, the entity is planning to sell its headquarters, and has initiated actions to locate a buyer. Okay, so it's trying to locate a buyer for its property, and it intends that it's going to transfer the building to the buyer after it has been vacated. So as soon as the entity moves out of its building, it will then do the transfer of the building. And so the question is, can it still be held for sale? Like, would this be available for immediate sale? Well, In this case, the answer is yes, because it is customary that in these with these types of sales, that the seller would then vacate the property, and this is a normal thing that happens, and so we can say yes, this building is in fact available for immediate sale, and therefore the classification as held for sale would still be appropriate. Now, what if the entity is only going to transfer the building to the buyer after construction of their new headquarters has been completed? So in this scenario, can we then still classify it as held for sale? Okay, and in this case, the answer is no. We cannot classify it as held for sale because it is not available for immediate sale. In order for it to be available for immediate sale, the construction of the headquarters, the new headquarters, would then have to be completed. Okay, moving on then to example 2. So in example 2, we see that an entity is planning to sell a manufacturing facility and it has initiated actions to locate a buyer. There is, however, a backlog of uncompleted orders. Okay, so this manufacturing facility still has orders that needs to be completed, and the question is, well, how exactly does this factor into the determination of whether or not this asset is held for sale? Okay, so let's look at more information in the scenario. So it tells us that the entity intends to sell the manufacturing facility with its operations and any completed orders transferred to the buyer. Okay, so whatever's not being done by the current owner is then going to be fulfilled by the buyer. Okay, so can it still be classified as held for sale? Okay, I would say definitely yes, it can be classified as held for sale, because the fact that there are these backlog of completed orders really is not inhibiting the transfer, because the facility plus its operations are being transferred, as well as the uncompleted back orders. Okay, now what if the entity intends to sell the manufacturing facility without its operations, and the transfer can only happen after all the backlog orders have been fulfilled? Okay, so would we then still be able to classify it as held for sale? And in this case, we would say no, because we first have to fulfill all of the backlog orders, and only then would it be appropriate to classify it as held for sale. Okay, let's look at the last example in this regard, which is example 3. And in example 3, it talks about an entity that has acquired a property that consists of land and buildings. It's acquired this property through foreclosure, meaning that whoever owned it before defaulted on their mortgage payments, and now the property is being foreclosed upon, and the entity has purchased this property and they intend to sell it. Now, the entity is not going to transfer this property to the new buyer until renovations have been completed. So they're getting the property, doing renovations, then they're going to transfer to the new buyer. And the question is, can it still be held for sale? Okay, so clearly it's not going to be held for sale because it is not available for immediate sale in its present condition. It still has to go through these renovations, and only then can it be transferred to the new buyer. Okay, so after renovations have been completed, it now classifies it as held for sale. But then at that point, the entity becomes aware of environmental damage requiring remediation, and the remediation must be completed before the transfer. And so the question is, can it still be classified as held for sale? And the answer here is no, because it can only be held for sale once this damage has been remediated. And in this case, we would then look at the guidance in terms of paragraph 26 to see how we deal with this reclassification. Okay, now in paragraph 7, we said that we can only have the asset recognized as held for sale if it's available for immediate sale and the sale is highly probable. Now, what does it mean for a sale to be highly probable? Really, paragraph 8 is where we look to for guidance, and it really gives us 6 criteria that we look at to determine whether a sale is highly probable. Okay, so the first criteria is that the appropriate level of management must be committed to selling the asset. There must also be an active program to locate a buyer, and to complete the plan, the sale plan, it must already, this program, sorry, must already have been initiated. So they must already be in the process of getting a buyer, and then have a plan to sell the asset. It must also be actively marketed for sale at a price that is reasonable in relation to its current fair value. So if you have a property that is way above, that's being marketed at an amount way above its fair value, then in that case we would say it's actually not reasonable that this thing is going to be sold. So it wouldn't meet this criteria of highly probable. Okay, the fourth one says that the sale should be expected to qualify for recognition as a completed sale within 1 year from the classification. So it's really important that once you classify it as held for sale, the intention is not that it's going to go on for years and years and years. There is an exception to this criteria, which we will look at later. Okay, now the fifth criteria is that actions to complete the plan should indicate that it is likely that significant changes to the plan will be made, or that the plan will be withdrawn. Okay, so it's unlikely, right, that we're going to have to make big changes or that we're going to withdraw the plan. And if this is also in place, then it really indicates that the sale is highly probable. And the last criteria is that if we need shareholder approval, so let's say based on your jurisdiction, you need your shareholders to approve of the disposal of these non-current assets. Maybe it forms a significant part of the total non-current assets, then that approval also needs to be factored in before we consider whether the sale is highly probable. Because if it is unlikely that shareholders would approve this, then of course the sale is not highly probable, because the sale cannot be concluded without shareholder approval. Okay, so these are the instances that give us a sense of whether or not a sale is highly probable. Now, in this criteria, I mentioned that there is an exception to this 1 year rule to complete the sale. Okay, and in paragraph 9, it tells us that there are events or circumstances that may extend the period to complete the sale beyond 1 year. Okay, now if this happens, it doesn't necessarily mean that we are not allowed to classify the non-current asset as held for sale. Okay, we really need to ask ourselves, is this delay being caused by circumstances that are beyond the entity's control? And is the entity still committed to selling the asset? Okay, and in order to determine whether we can apply this this exemption of the 1 year rule, we're going to look at Appendix B1. And Appendix B1 kind of summarizes three sort of scenarios you could be in order to determine whether or not the 1 year rule exception could apply. Okay, so the exception to the 1 year rule may apply, firstly, okay, if at the date that the entity commits itself to a plan and it reasonably expects that others, but not the buyer, are going to impose conditions on the transfer that are going to extend the period to complete the sale, okay, above 1 year. And actions to respond to those conditions can only be initiated when the entity has a firm purchase commitment, okay, and now it has determined that a firm purchase commitment is highly probable within 1 year. Then it means we can use this 1 year rule exception, and we can still classify the property as held for sale. Okay, we're going to look at examples straight after this. Now, the next situation is when entity obtains, now they've got a firm purchase commitment, and now the buyer or others unexpectedly impose conditions on the transfer that are going to extend the period to complete the sale. Okay? And the entity has taken timely actions necessary to respond to these conditions and expects a favorable resolution of the delaying factors. So if the entity has already taken these necessary steps and the entity anticipates that it's favorable, that these will be resolved, then of course the entity can still classify the non-current asset as held for sale. And the last sort of scenario is during the initial 1 year period, circumstances arise that were previously considered unlikely and that result in that were considered unlikely that result in the transfer to concluding at the end of that period, and then the entity took action to respond to the change in circumstances. Okay, so something happened then that was previously considered unlikely, and now the entity has taken action to respond to those changes, and the asset or disposal group is still actively marketed at a reasonable price, and the requirements of paragraph 7 and 8 are still actually being met. So if we still have this situation, then of course we have this 1-year rule exception, and we can still classify this property or this non-current asset at least as held for sale. So there are illustrative examples that further where we could apply these exceptions. So let's have a look now at those illustrative examples. Okay, so the first example I want to focus on is example number 5. So in example number 5, we're told that a power generating entity is planning to sell a disposal group that represents a significant part of its regulated operations. Now, the sale requires regulatory approval, and this could extend the sale beyond 1 year. So actions to obtain approval can only be initiated once a buyer is located. Okay, so they can't get the approval until they actually have a buyer. Now, if a firm purchase commitment is highly probable within 1 year, then in this case, we can classify the power generating entity as held for sale. Okay, in the next example, it tells us that an entity plans to sell a manufacturing facility in its present condition and classifies it as held for sale. Now, after obtaining a firm purchase commitment from a buyer, the buyer then inspects the property and identifies that there is environmental damage that was not previously known. Okay, now before the transfer can take place, the entity has to make good on this damage, and this is going to extend the period to complete the sale beyond 1 year. Okay, so if the entity then initiates actions to fix the damage, right, and satisfactory rectification of the damage is highly probable, I guess it's highly probable that it's going to be successful, then the entity can still classify this as held for sale. Okay, and the last example in this regard that I want to refer to is example 7, and it says here the entity is committed to a plan to sell a non-current asset that it classifies as held for sale. Now, during the initial 1-year period, market conditions have deteriorated, and the asset is not sold at the end of that 1-year period. The entity continues to actively market this asset, and it reduces the price. So can we still classify it as held for sale? In this case, yes, we can, okay, because we're still actively marketing it, and by reducing the price, it's probably likely that this asset is going to be sold. Now, during the period following the 1-year period, okay, so now we're in the 2nd year, the market conditions further deteriorate. Okay, so we weren't expecting this, but unfortunately it further deteriorates. Now, the asset still isn't sold at the end of the 2nd period, okay? But the entity is not reducing the price because it believes the market will improve, and the asset continues to be held for sale but at an amount that is greater than its current fair value. So the question here is, can it still be classified as held for sale? And in this instance, because the market has experienced sort of a continuing downturn, and now that the entity isn't changing the price at which it is marketing the asset, it probably is no longer able to classify it as held for sale because it's unlikely that this asset is going to be sold. Okay, now the next thing in terms of recognition I want to look at is just assets that are abandoned. Okay, now with assets that are abandoned, IFRS tells us that we cannot classify them as held for sale because the carrying amount is principally being recovered through use. And of course, you can only classify it as held for sale if you're recovering your carrying amount through sale. Okay. However, there are going to be separate disclosures that are required if your assets are abandoned. Now, an asset can be taken temporarily out of use, and in that case, if it's just temporarily taken out of use, then we do not account for it as if it were abandoned. Okay, so illustrative example number 8 really demonstrates this point. Okay, it says that an entity ceases to use a manufacturing plant due to decreased demand for its product. Okay, so the plant is still in a workable condition and it will be brought back into use when demand picks up. Okay, and so the question is, can this plant be regarded as abandoned? And really the answer here is no, it's not regarded as abandoned because it is still in a workable condition, and once demand picks up, it will then be brought back into use, so we wouldn't regard this as abandoned. Now that we've talked about the classification as held for sale, let's talk a bit about measurement. Okay, so the measurement, how do we measure a non-current asset held for or disposal group held for sale? So the standard tells us that it's measured at the lower of its carrying amount and the fair value less cost to sell. And really this makes sense because why would we limit the carrying amount to the fair value less cost to sell? Because we're expecting to recover our asset through sale. Okay, and so if the fair value less cost to sell is lower than the carrying amount, then we would have to reduce it because we cannot recognize our asset at an amount that is greater than the benefits that we expect to receive for our asset. Okay, so the important principle here is that firstly, you're going to determine the carrying amount in accordance with the applicable IFRS. So let's say it's PPE, for example, you're going to look at the requirements of IAS 16. You may need to impair the asset as well, but you're first going to do it in whatever the applicable IFRS is. Okay, then you would do your reclassification. Now, in terms of the measurement of disposal groups, okay, specifically because we're going to look at an example here, we're told that any impairment loss or subsequent gain recognized for a disposal group is going to reduce or increase the carrying amount in the order of allocation set out in terms of paragraph 104A, D, and 122 of IAS 36. And what this really is talking about, it's saying that if we are going to impair our disposal group in terms of IFRS 5, the way we allocate that impairment is based on how we do it in IAS 36, meaning we first allocate it to the goodwill, and any remaining impairment is going to be prorated to the remaining assets. So in order to illustrate this principle further, or this requirement further, let's look at example 10 in the illustrative examples. So in example 10, we have at our previous reporting date, we have the carrying amount of our goodwill, PPE, inventory, and equity investments in our disposal group, and the carrying amount of all of those are, it comes out to 16,000. Now, just before we do the reclassification, we have to determine the carrying amount of all of these assets, okay, and we're determining it in terms of the applicable IFRS standards. So the carrying amount now is revised to this 14,900 because we've redetermined the carrying amount just before we're doing the reclassification. So how do we then reconcile these numbers, and how do we go about doing the reclassification of this disposal group? Okay, so immediately before the reclassification, the entity is going to recognize an impairment loss. Why? Because we're determining the carrying amount in accordance with the applicable IFRS standards, and so there's going to be this impairment loss. The way we calculate the impairment loss is the 16,000 minus the 14,900, and that gives us an impairment loss of 1,100. Okay, so that impairment loss is going to be recognized in terms of the way we would do it with IAS 36 and the applicable accounting standards. Now, at the point of the reclassification, the entity now measures the fair value less cost to sell of this disposal group as 13,000. Okay, now we know that the principle is that we're going to measure it at the lower of the carrying amount and the fair value less cost to sell. So on reclassification of the disposable group, okay, we're going to compare its carrying amount, which is 14,900, to the fair value less cost to sell of 13,000, and we say that then there's going to be an impairment loss of 1,900 in terms of IFRS 5. Okay, so that impairment loss, okay, is going to be allocated to non-current assets. Okay, and assets can only be, allocated to non-current assets and assets that are within the scope of IFRS 5. That's really important, and that's why we look at the scope right at the beginning. Okay, so that means that no impairment loss will be allocated to inventory because inventory is a current asset. Also, the investments in equity instruments, we are not going to allocate impairment losses because those investments are being accounted for in terms of IFRS 9, and that's out of the scope of IFRS 5. Okay. The loss then is going to be allocated in the order set out by IAS 36 paragraphs 104 and 122. So that means it's first allocated to the goodwill and then it's prorated to the remaining assets in the disposal group. Okay, so let's have a look at how we do that. Here we have all of our assets in our disposal group, and this is the carrying amount as remeasured immediately before the classification. Now we have a 1,900 impairment that we need to recognize, and we're first going to allocate that to the goodwill of 1,500. So we completely wipe out the goodwill. Then we will allocate the remaining impairment losses to the PPE assets. So no impairment loss to inventory and equity instruments, because those are not in the scope of IFRS 5, but we're going to prorate our 400 impairment loss to the remaining assets by looking at the carrying amounts of the PPE. Okay, so we allocated the impairment loss over there, the total 1,900, and then we have a carrying amount after the impairment of 13,000, which is the fair value less cost to sell, and that's exactly what we wanted it to be. Okay, so that is the end of my presentation on IFRS 5. If you enjoyed this content, please make sure to give it a like and subscribe to my channel so that you are updated whenever I post new content. Also, if you have any questions, please post them in the comment section and I will make sure to get back to you. I will see you in the next video.